Good morning, everybody. Thank you for joining us today and supporting this event. As John mentioned, my presentation is the first of the two Boolers presentations. It's going to take more of a retrospective look at financial markets over recent times and to try and make sense of them, really. So three real sections of the presentation. The main part of it is looking at where markets have come from and where it leaves us. Gavin's presentation would be more forward-looking and taking it from there. In doing so, I'll also look at how we reacted to the return of inflation, which has been really the key theme of the last couple of years, and if time permitting, allude to the path to recovery as I see it. Now, in this presentation, I'm deliberately going to go back beyond 2023, and that really is because I think I see 2023 as being more a sequel to 2022, which for me was the main event when we saw inflation return with a vengeance. And you know, if we talk about 2023 without bringing 2022 into it, it's a bit like watching Godfather 3 without having watched the earlier movies. You really need to bear in mind 2022 for the full context of why 2023 performed as it did. So I'm going to start with a question, which is where we are today as a result of yesterday's priorities is a rhetorical question, because I believe the answer is yes. My belief is that big shifts in financial markets really are rooted in events or reactions to events that took place one or even several years earlier. So, for example, the return of populism towards the end of the last decade had much to do, in my view, with the global financial crisis and decisions that were made at that time. In a similar sense, you know, just as 2023 was a sequel to 2022, I believe that 2020 was a prequel to both of them, because that saw COVID and really the economic stimulus or overstimulus that gave rise to the inflation that we saw in 2022. So these things are all linked and they're all relevant. So 2023, how did we get there? So I'm going to take us back in time a little, and in doing so, to keep things simple, I'm going to focus on the US and UK equity or share markets, and I'm also going to look at, I'm going to throw in UK government debt as a bit of a contrast as well. So for the UK, for illustrative purposes, I'm going to use the FTSE 100 index, which is the UK's 100 largest stocks, so the other end of the UK market from Liontrust UK smaller companies. I'm using that because it's more sort of old economy. The stocks that dominate that index are really your banks, oil, energy, fossil fuels, basic materials, industrials, pharmaceuticals. And for the US, I'm going to use the S&P 500 index, which is the other end of the scale. It's dominated by the Magnificent Seven, big tech, Amazon, Google, Microsoft, etc. So very different ends in terms of market sectors, so you'd expect very different performances. UK gilts or government debt, I'm putting that in there really because that's, for portfolio construction, asset allocation purposes, that's our go-to sort of safe haven. So for when equity markets are under pressure, you know, gilts are usually there to bail you out. Well, that's the plan anyway. So we'll see how that turned out. So I'm taking us all the way back to February 2020. When the COVID epidemic became a pandemic, so it went from being a China problem to an everybody's problem. Now, global stock markets fell from February 2020. So that was a period where it heralded half of the global economy shutting down, something that's never really happened before. Even if we include world wars, economies keep going, it's just their function changes. But we actually saw an artificial grinding to a halt for a lot of the global economy. Global supply chains collapsed, so everything from toilet paper to dominoes just became impossible to access for a period of time. But most alarmingly, we were told right at the beginning, around February time, that it would probably take about 10 years to formulate a vaccine to actually deal with COVID. And for me, that was probably the most alarming piece of news, because that meant that the new normal that we're settling into would probably not go away very soon. So how did stock markets react to all of this? Well, this is really just showing January to the end of March, and pretty much as you'd expect, stock markets didn't do very well at all. The FTSE 100 over a 6-week period from sort of mid-ish February to late March, it lost about a third of its value, which is really scary over a 6-week period. To put that in perspective, some indices actually lost the same or more over a 6-week period than they did over a period of about 11 months during the financial crisis. So a very scary time to be invested, not a pleasant time to be an investment manager. Gilts actually, they offered some relief, so you can see that gilts actually rose by about 7%. So that gave some floor to diversified portfolios. The more cautious investor you are, the more you can have exposure to gilts. But if you're an adventurous investor, you're going to be 90% plus invested in equities. So really a very uncomfortable time. Then from March 2020, and we're talking really pretty much for most of the rest of the year, lockdowns and infections peak. Really, this is where all the bad news actually happened. So February, we were looking forward to things getting worse, if that's the right term, but March onwards is when things got really bad. We saw some of the worst recessions we've seen, certainly in my lifetime. In the US, we saw the worst recession since the Great Depression. In the UK, the FTSE 100 and the UK stock market saw its worst recession in over 300 years. Interest rates fell to a level that we've not seen since the formation of the Bank of England, I think in the 1600s. So a lot of new territory for us in a very short period of time. We had an estimated output loss of $9 trillion over that period. That's a huge amount. So bearing in mind all of this bad news in this huge crescendo, how did markets react to that? Well, actually, probably not as you'd expected. For most of the rest of the year, markets actually went up. Why? Because everything's going wrong. Why did markets go up? Well, the reason for that is really that markets are forward-looking. So they're looking through all of this. They're looking through this really terrible bad news and everything looking very dark. They're looking through to the other side, to good news at the other end, because they want to be ahead of the curve. They don't want to wait until things have got better before they invest. And so we saw a period really for the rest of 2020 of what you'd see as good economic news, in that although the global economy was in partial shutdown, you saw extreme economic stimulus from governments and central banks to a level that we've just not seen before, and I'll come on to that. You know, the recessions themselves, they lasted for 2 quarters. They were the shortest on record. And most encouragingly for me, I think, was the fact that early on, you know, within a few weeks of the darkest point of the markets, we were told that vaccine trials should be up and running by September. So that was a big revision. And you can see in this chart, really the red line is the S&P 500. That ran away with things, but that's because of the tech focus, because tech wasn't really affected by things. Tech benefited. I'd never been on a Zoom meeting before lockdown. And so tech came to the forefront and saved us in many ways. We all went home at Boolers 23rd of March and worked from home. And it's ironic that that's the same date where the market troughed. That was the bottom of the market. And from there on, it just got better. The FTSE 100, it did rise, but it sort of bobbled around for a bit. And that's because it was more weighted in oil and fossil fuels. And if you remember, road traffic in the UK in those summer months was down 90%. So the fact that it was weighted in areas that were struggling, and in April 2020, you actually had oil futures trading negatively, which I don't remember that happening before. So the FTSE 100 was put under pressure mainly because of the stocks that dominate it. But even the FTSE 100 had a good period sort of towards the end of the year, around about November, where you had a real value rally. And that had much to do with the fact that stage 3 trials of the vaccine were completed, and there was a clear path to us getting back to work and to the economy picking up again. So markets not behaving as you'd expect, but that's because they're forward-looking and they're expecting things other than what we were at the time. So we get to 2021. Lockdowns end, unless you're living in China. Global economic activity, it starts to pick up again. We're not quite at normal, but we're moving a long way in the right direction. If stock markets continue to rise because that's good news. But inflation also starts to rise at the back end of the year. Now, if we look at how markets did, and this is throughout 2021, it's pretty much good news. Government debt, pretty unimpressive, pretty boring, just moving within a defined range, but it's good news almost wherever you are for equities. There's certain styles of equities that outperformed in 2021. It's a dovetailing sort of year, but generally it's more of an everything rally for equities, particularly US, because again, tech continued to benefit, but the FTSE 100 did fine as well, because it benefited from an increase in industrial production. So, more demand for oil, fossil fuels, mining stocks, etc., commodities. They all did very well. But that area began to overheat towards the end of the year, and you can see a slight pause, a slight bit of uncertainty right at the end of that chart, and that really has a lot to do with thoughts about where inflation was going to go. In the back half of 2021, the phrase that, oh yeah, this inflation that's coming in from the mid-year, that it's transitory. Transitory became a buzzword, and at the end of the year, it sort of died out. So in December 2021, UK led the way with central banks and started to raise interest rates. Up until that point, interest rates in the UK, we'd got a base rate of 0.1. which we're just not used to. So it's not unusual to expect that to lift as soon as it's economically prudent to do so. Now, in response to that, and at the back end of the year, bond markets and US equity markets fall, but the US equity markets, nothing to do with UK interest rates. It's more to do with general unease about inflation. Is it transitory, or is it going to be more deep rooted? And here we're looking at about a 3-month period from December onwards of 2021, where we're looking at the US equity market in red, really not having a good sort of end to 2021, start to 2022, because the very thing that made tech attractive, free money, that would disappear with interest rate rises. Tech stocks would suddenly look very, very expensive. So in January, you had the worst month for the Nasdaq in several years. It was really quite stark, because people started to think these tech stocks all of a sudden they look very expensive, particularly if you expect inflation and interest rate rises. However, the FTSE 100 was doing fine, because the very things that were driving inflation are the very things that dominate the market in terms of sector representation. So FTSE 100 did fine. Gilts, you will see, they fell along with US equities, and that's because they're badly hit. Interest rate rises are not good news for gilts, and I'll come on to that. So we get to February, Russia invades Ukraine. I personally didn't think that would happen. I thought that all of that military surrounding Ukraine was another bluff, just like it had been the previous June when he'd done it then, but it wasn't. He invaded Ukraine. Fortunately, we'd actually halved our emerging markets exposure the day before, but that was luck rather than good timing, I think. But what happens there? Well, Russia invades Ukraine, inflation mushrooms, and bonds and US equities continue to fall. Now, if we look the following month, it's compounded by the fact that US interest rates start to rise in March. So let's look at about a 6-7 month period, sort of from early on in the year, really taking us to September. It's bad news almost where you look. The only thing that's keeping the FTSE 100 going is really oil and energy, because as bad from a humanitarian point of view as the Russian invasion of Ukraine was and is, it's really when markets are affected, it's because of global trade, it's trading relationships. If that's at threat, that was the main thing that made markets fall when we had COVID. It's about global trade. And so here we have a situation where an old trading relationship between Russia and the West for primarily oil and gas, but other things, fertilizers, soft commodities. But if you take oil, for example, we'd been buying Russian oil since at least the fall of the Soviet Union, and Russian gas had been piped into Europe since, throughout the Cold War and Cuban Missile Crisis. It didn't stop, but all of a sudden it stops. Now, if if you fracture that relationship and we have to source, Russia has to sell its oil elsewhere, we have to buy gas from elsewhere, and we have to do it at greater cost and from new partners, that's a short-term energy supply shock. So effectively what that did, we came into 2022 expecting inflation. We expected inflation, we expected interest rates to rise, but we expected inflation in the UK to probably peak at around about 7% and probably be dying down again, peak by the third quarter of 2022. All the Russian invasion of Ukraine did is just turn our expectations up to 11. So we had UK inflation up to 11% and persisting until the first quarter of last year. So really a very negative period. And you can see that gilts have been particularly hard hit during this period because it's not so much the inflation, but it's the interest rate rises that you expect to combat inflation. As interest rates rise up, the fixed income that you receive from government debt and corporate bonds, that becomes less competitive, and so the only way that they can compete with rising interest rates is for the capital values to fall. And so 2022 was a bizarre year where equity markets were under pressure, but also the very go-to place that you go to, which was gilts, they were struggling even more, and so the gilt market underperformed many equity markets, including UK mid-cap equities, which is unusual, shall we say. So we get to September, Trussonomics begins. It's a relatively short area in British political history that is still notable, but we had basically bond and equity markets falling in response to the now legendary mini budget, where you had huge unfunded tax cuts and spending promises that the bond markets basically that bankroll government spending to an extent. They just didn't like it, and so what we had is FTSE 100 fell a bit, but bearing in mind we still had inflationary pressures and the things driving inflation, it was a good place to be during that period, relatively speaking, but it wasn't very popular. It was a grim period, but happily that only lasted a month. So we get to October and the era of Trussonomic ends, and bond and equity markets they actually rise. It'd be unfair to say that Liz Truss's departure actually gave way to a bull market in equities. That had more to do with general optimism that inflation had just about peaked in the US, and there was optimism that therefore the trajectory of interest rates would actually top out and start to fall. So it's basically when markets see that trajectory, that forward looking, they see a positive outcome on the horizon. So we sort of finished the year, we finished 2022 with a degree of optimism, which takes us to 2023, a year I define as optimism versus setbacks, or 3 steps forward, 2 steps back. This is all on one slide, thankfully, but it was a busy year, even though from the market return at the end of it may not have felt like it. But we started the year positively enough with, we had the China COVID policy came to an end and they finally unlocked, and we had a lot of optimism around the big China reopening trade, big consumer domestic boom. China's a really important economy to the world. China's driven about 36% of global economic growth over the last 10 years. So China getting back off its knees and producing again, that's good for all of us. However, that gave way to disappointment early in the year as the inflation numbers started to come through the US and the UK. Inflation is what we call sticky. It's going down, or in our case, it wasn't going down, but it's basically not going in the direction that you want to. Either it's just not going in that direction, or it's not going in that direction as quickly as you'd like it to. So we had sticky inflation, but we also had sort of February, March, we had a US mini banking crisis with Silicon Valley Bank. A typical run on the bank, but untypically it happened over an extremely short period of time, causing panic among sort of regional US banks, which turned out to be a bit of a storm in a teacup, but it concerned markets for about a month. Then we actually get to the mid-year point, and we see a decoupling of the US and UK, where in the US it's all good news. There's very real evidence of falling inflation. We get to the third quarter and interest rates the interest rate hikes cease. And going into the summer, if you remember, we had a lot of hype around AI, which hadn't completely gone away, but it was sort of, well, it was very much present going into the mid-year point last year, and people were looking for ways to access AI. And so that was probably the thing we got asked the most about. Just as during lockdown, the thing we were asked most about was Bitcoin, and we've moved on from that slightly. But AI is a theme that's persistent. We've had exposure to AI for, I think, 3 years now. On the other side of the coin, UK, our inflation was more sticky than US. So there are structural factors within the UK relating to labour market and other things that means our inflation has taken a little more effort in getting to come down. Then we go through the summer and the optimism in the US dissolves. Basically, you have big increase in the oil price, around 20% increase to the oil price, which that's inflationary, so it takes away confidence that could we see more rate rises. You also importantly had a credit rating downgrade for US Treasury debt. Now that's important because that determines the rate that the US is going to be paying on its debt in the market, and US borrowing continually heavily. We have very high government borrowing in the UK, the US even more so. So we then get to October and we have the Gaza situation, which was, again, very bad news for stock markets, because immediately you have, it's not so much the oil price increase because oil had already been rising in price, it's the fear of it escalating into a wider conflict. And again, coming back to what does that mean for global trade? We've seen disruption to shipping in the Red Sea. That was one of the concerns. But also, would Iran get involved? And if Iran gets involved, you've got the Straits of Hormuz as well and oil transport. There's all sorts of things that can go wrong in the Middle East. So markets are always nervous when things happen in that region. Happily, we ended the year with what we call the everything rally, where markets took about 4 weeks to work out it's not going to escalate into a wider conflict. Now that's a moving thesis that can change very quickly, but for the time being, towards the end of 2023, markets decided no, this is relatively contained, and we then started to have, for the first time, having inflation disappointments for the whole year, where the figures were disappointing. We actually got good news in the space of 1 week in the US and the UK. Our inflation dropped below 4% to 3.9. So very good news week, and interest rates topped out in the UK as well. So everything went up at the same time, and the Fed pivot, that's basically the Federal Reserve in the United States actually talking about a pathway to interest rate cuts for the first time. So the November, December was a very positive period for stock markets. We're glad it came along, because without it, we would have probably been sitting level or slightly down for the calendar year. But as it was, portfolios were actually, they finished the year in positive territory. So the inflation bubble, I refer to 22-23 as being an inflation bubble. And that's simply because here's a chart of UK, US, European inflation going over more than the last couple of years. It's going over quite a few years. And you can see that at the start of the chart, in the response, the aftermath of the financial crisis, we had an uptick in inflation, UK inflation ticking higher because you had various other factors at play there, particularly with weaker pound, for example. But look at the back end of it. That's the inflation bubble right there. It's very distinct, and it's also relatively short-lived. So this chart really illustrates why I would say that we can't really talk about 2023 without talking about 2022. That dividing line is the dividing line between those 2 years. 2022 was the year of inflation going up. 2023 was it coming down. Why did inflation go up so much? Well, it's coming back to big market shifts being rooted in earlier events. So, COVID gave rise to a very big government and central bank response. This is a chart that I put in an investment commentary in June 2020 when we were still in the first lockdown, and it looked at the scale of government and central bank response expressed as a percentage of gross domestic product of each nation, and it looked at it over a period of 3 months compared to 12 years of measures designed to tackle the global financial crisis. Now, I'd been going to investment seminars for years after 2008 and being told consistently, we pull big financial levers there. If we have another financial crisis, we've got no more big levers to pull. Well, as you can see, the orange is the 3-month response at that point. There was a very big lever somewhere, and it got pulled mostly across the globe. Now, bearing in mind this big response is basically like a big wall of money being thrown at financial markets. Why did inflation fall again relatively suddenly? And it's largely because we went into this with big economic stimulus, record loosening. And we've come out of it with record tightening. We've had interest rates rising at a velocity that I've not seen in my career. Here you see the years following the financial crisis. The US in blue at least made some efforts to build their interest rates back up from where they were pre-financial crisis. The rest of us didn't really bother that much. And then COVID came along and just crashed all of those efforts and put the rates lower than where they'd been in the first place. So you can see that the response is a very steep one. We got used to monthly interest rate increases of 0.5, 0.75%, the same thing happening the next month and the next month. That's very rare. And you can see now that thankfully there's something of a plateau. Usually historically, after a plateau of interest rates, they don't tend to keep going up in the direction they were just going. We believe the direction will be downwards from here. The conversation is when rather than if. So, separating markets from geopolitics, it's fair to say that if you switch on the TV or look in a newspaper or online, the world looks a very scary place at the moment. There's war and a lot of discord in the world at the moment, and political backbiting, and so I've looked at this because we get asked about events that aren't strictly speaking economic or market related, but it's saying, well, how's this going to affect markets? And I've tried to separate things out into what I'd term primarily economic events, geopolitical events, and other. Now, Russia, Ukraine, and Gaza, Israel, they've actually been put in geopolitical, whereas you might think they're other, but a lot of armed conflict, in my view, is really a breakdown of politics. It's where politics has failed to resolve difference or conflict, and then it becomes armed. Now, I'm looking at this from the perspective of, we've seen that, we saw with Russia, Ukraine, that tilted stock markets for about a month before it was recognised that probably wouldn't drag NATO in and become a wider conflict. All it did is push inflation higher that was already a problem in the system. Gaza, Israel, markets panicked a little bit. They were uneasy for about 4 weeks and then reasserted themselves. So we're not in a position yet where we can say that these conflicts alone have actually impacted markets over the longer term. Whereas things like the response to COVID, well, that gave rise to inflation a couple of years later. That's a multi-year thing. Inflation, that will impact markets for a period of time. Interest rates, these are all economic stimuli that do have an impact on markets. They are things that we do concern ourselves with. Recession, soft landing, these are all things that will drive market returns. Things that have driven markets to an extent, global currencies, that's another one. If we look at last year, for example, the Japanese stock market was at 28%. But if you're a sterling investor, the yen weakens significantly against sterling. You only got about half of that return because of currency effects. So global currencies have had more of an impact on market returns for how you're invested than, North Korea trialing cruise missiles or even Trussonomics. And so the point I'm trying to get across here is that geopolitical events are important, but they're not always the big drivers of market returns, the end results in your portfolios. What they tend to do is they tend to become multi-year thematic things that we have to worry about later on, that may have impacts later on that we can't foresee now. And we can only allocate and we can only invest with things that we can see. The ones that are sort of in the orangey colour are things that are in between. They're things that are worthy of separate comment. So Russia-Ukraine I've commented on, that was something that affected global trade. COVID affected markets, but it's only because it provoked an economic response. Climate change is massive. That's massive to our industry, it's massive to investing, but it's one of these multi-year thematic things. One of the questions that we have been asked sort of relates to that, so that's something that will be covered in Q&A. But generally the message I want to get through here is the last couple of years, despite all of the headlines that make us fear the world is ending, what the market has cared about has been mainly inflation and the response to it. So investing through the inflation bubble, this has been a really interesting time to be an investment manager, putting it politely. And if you're looking at the conventional investment wisdom for portfolio construction, if you're trying to invest to deal with inflation, what you really want to be investing in is real assets, things that tend to have a long-term track record of beating inflation. So you're going to have real assets, equities, property. Residential or commercial property, and gold. Gold is another inflation hedge, so that's another option. There are loads of options, but these are the main ones. And you tend to avoid assets that are nominal assets that will perform with or under inflation, so cash and bonds, government debt. You will tend to not invest in those if your aim is to beat inflation. On the other hand, whilst we were dealing with inflation, you could see that we were dealing with real market volatility. So if you're investing and only looking at market volatility, what do you invest in and what do you avoid? Well, you hold bonds and cash because they're lower volatility, but you reduce exposure to real assets because they're the ones that have got all the volatility. So you can see there's a mismatch here, and it's very difficult to satisfy both at the same time. So we can't defy gravity. We have to try and plot course through the middle through that period. So how did we respond at portfolio level and in asset allocation terms? Well, to beat inflation or to combat inflation, we sold government debt. We were completely out of government debt by May last year, but we'd been reducing it from November 2022 as soon as we started to become more concerned about the effect of inflation. And as soon as inflation became something that wasn't going to be gone within a couple of months, and we weren't happy to sort of sit through that wave and invest through it. So later we were arguably more active in the number of changes we made, but essentially we tried to take the risk assets, which is equities, and just dial down the risk a bit. So we reduced small and mid-cap UK equity exposure, apologies, line trust, and we bought FTSE 100 because we saw at the beginning of 2022, we want oil and gas, we want exposure to the things. It's another form of hedging our bets, really. We sold it a year later, so we have no FTSE 100 holding in our portfolios now. We halved our exposure to emerging markets very fortuitously, timing-wise, and we bought global value equity. So again, we're looking to buy the cheaper, sort of more industrial type industries that had less far to fall in volatile times and were actually on the rise. And we added to cash and bonds. So you can see, bearing in mind where we should be invested, this was us walking a tightrope and compromising as far as possible. So the path to recovery, to bring us to an end really, this is UK inflation and interest rates. So you can see the inflation curve, and you can see where interest rates have risen to rise it, have risen to meet it. So interest rates currently sitting at 5.25. The big debate is, when are they going to fall? Not are they going to fall, is it going to be this year? Is it going to be April? Is it going to be March? Is it going to be July? Is it going to be August? And how many rate falls and how big are the rate falls? And we've got an election coming up. Are they going to get them out the way before the election? All of these questions. So the speculation is about when and how much, not if. And so a lot of the market volatility you're seeing is about that interest rate trajectory here and in the US. But what you're seeing here is just one way. It's just an upward staircase with interest rates. So if we look at the US, and the blue line again is the US inflation trajectory. They're slightly ahead of the curve with us, and so you can see a better illustration with their interest rates, where the dotted line is forward guidance really. You can see that interest rates do follow this inflation curve. And so to basically cap that offers to what we see as a path of recovery. This is a story that we're already most of the way through. We've dealt with pretty much all the uncomfortable parts of it. So we've seen inflation rise in late 2021, and we've seen interest rates rise to meet them in 2022. We've seen inflation peak. We believe now we've seen interest rate peaks. So this back and forth, we've done that. So late 2023, the important bit is this Fed pivot. The reason for the everything rally is that we've seen that market rally because we believe we're at that plateau now. And so 2024, it's more about interest rates falling, and then hopefully 2024 market recovery. Now, I'm in danger of treading on Gavin's toes at this point, so I'm not going to go any further with that. But this path to recovery I see as like trying to get from Leicester to Manchester using the M6. You're going to get unexpected events and delays along the way, but it's not a question of if we're going to get there. We are going to get there. That was my presentation. Thank you very much.
Good morning, everyone. Thank you for coming back. Hopefully we're all refreshed. My presentation today, I'm going to be looking at 3 areas. I'm going to look at our portfolios and how they've actually performed. I'm going to look at our asset allocation and where we're investing at the moment. And then I'm going to finish off with the potential for the future and where we see things going. We know that over recent years we've had lots of headwinds to deal with, but what has their impact actually been on performance? So the chart here, if you can see it, it's our balanced risk portfolio. So we've used it as a proxy for returns. And we're looking at the last 5 years, and on the chart I've put with the green arrows those major headwinds that we've faced. So we can clearly see that at each one of these events, markets have reacted negatively. But on the positive side, they've recovered. So whilst it's not been a smooth journey over the last few years, we've still ended up with positive returns. Those blue squares indicate when we've made changes to portfolios, so that you can see that throughout all of these events, we've been actively managing the portfolios to try and get the best outcome that we can. So if we look at the performance in a wider detail, on the table here, we've got all of our discretionary portfolios. So we've got 3 risk categories: cautious, balanced, and adventurous. And we've compared the figures here over the last 3 calendar years and a 3 and 5 year period. We're showing the figures against our benchmark, which is the Investment Association Mixed Asset Sectors. And this is really important because these sectors are made up of our peer group. So this is all of the other wealth managers and managed funds that are investing on a similar basis to ourselves. We've colour-coded the returns, so you can see the colours there. Green's a bit washy, but the blue and green colours, that's first and second quartile performance. So it's pleasing to see that over the longer term, despite the volatility that we've had to contend with, relative to our peer groups, we've generated second quartile performance. So if we move on to our asset allocation, so where are we currently investing money? We're showing here the major asset classes, and we've got our 3 risk categories. So at the high risk end, adventurous, we've got the highest exposure to equities, UK and global markets. As we come down the risk scale, the exposure to equities reduces in favour of fixed interest and what we class as alternatives. By this, we're talking about particular themes, so infrastructure, artificial intelligence, global insurance. And Simon made the point at the end of his presentation, last year we raised cash in portfolios. We've recently deployed some of that cash, we've brought it down to 4%, and we've added to fixed interest. And that's largely driven around going back to interest rates. We think they've peaked. Fixed interest, we can lock into reasonable yields, but we're also looking for the capital upside as and when interest rates fall. We're still holding some cash, we're keeping it under review, we're looking at some particular themes in global equities that we might add to, but we're waiting for those opportunities to arise. So we move on to the potential. We know we've got headwinds, Simon's already covered some of these. We've got recession risk. Central banks, all of the rate rises that they've put through, they've tried to engineer a soft landing. It looks as though, certainly in the US, we've achieved the soft landing, but there's still a risk that that might deteriorate further. We've got central bank policy error. Now, central banks, They've gone through raising rates. The rate rises that we saw last year, it takes 12 to 18 months for those to wash through the cycle. So we've still got the potential that those rate rises cause us some discomfort. And then geopolitical. We know about Israel, we know about Gaza, Ukraine. We've got these big risks that we've got to contend with. Will they escalate further? And we know we've got a number of elections. We're mainly talking about the US and the UK in terms of elections, but those risks are there. But it's not all negative. We've got lots of positives to look at as well. We know we're going to get rate cuts. We don't know exactly when they'll start. At the beginning of the year, the markets were pricing in that the US would potentially cut in March. That's now been changed. But we know that these rate cuts will come through. GDP strength. Certainly last year, the US market was extremely resilient and outperformed all of its expectations. We've got the potential for that to happen again. And attractive valuations. We're really focusing on the UK here. We've heard all about it from Victoria and Anthony this morning. The UK market really is giving us some good opportunities. So I'll cover off some of these points in a bit more detail. This is quite a busy table, but just to highlight here, we're looking at a number of economists' forecasts for 2024. The diamonds are showing where we ended 2023, and the orange bars are showing the range of forecasts from different economists. So if we look at GDP on the left-hand side, again, going back to that soft landing environment, most economists think that we're heading for that soft landing. There is some potential to the upside, but hopefully there's a lot lower chance of us falling into recession. If we move on to inflation in the middle, again, this is more synchronized. The consensus view of economists is that inflation is going to keep falling from the levels that we're at the moment. The range there, I mean, in some instances, we're going back to central bank targets, but certainly close to them, which again is another positive. And then finally, on the right-hand side, unemployment. Again, the forecasts are that unemployment is going to tick up slightly this year. Interest rates. We've talked about interest rates all morning. This is purely focusing on the US market. So this is the Federal Reserve's expectations for interest rates over the next few years. The green line through the middle is the average Federal Reserve forecast. So if we're looking at 2024, we're looking at about 75 basis points of cuts expected. The blue and purple lines are the market forecasts. So the market is actually pricing in more rate cuts than what the Fed's anticipating. Now this chart was obviously end of December. The start to the year, we've seen some positive data. Some of those market forecasts on rates have moved slightly more towards the Federal Reserve. But the fact that we're getting rate cuts is just another positive support for both equity and bond markets. Elections. Now elections has been it's a big theme. We've had questions come through already about it. This chart is focusing on the UK market. The similar pattern will apply for the US market. The table is the annual returns of the FTSE All-Share Index over the last 38 years. Again, if we look at the individual years for the elections, markets have been volatile. We know that in the lead up to an election, there'll be some uncertainty. Markets will react to it, but then we'll see through it eventually. The real message here is that despite all of this volatility, trying to time a particular event is far riskier than just remaining invested, investing through the cycle and getting the benefit of those long-term compounding returns. The UK market. We've heard lots about it this morning. This chart is a slightly different take on one of Victoria's. It's the forward 12-month price to earnings ratio. We've got different categories, so we've got each different region and their PE ratio. The black line through the middle is the average. So we're looking currently that the UK market in the orange line is at a 20% discount to the global average. If we just look at the US market in isolation, we're over 40% discounted to the US. Now we know that's been driven by technology firms, the Magnificent Seven, the huge growth we've seen in that area. But the UK market, we've got lots of factors. We've got M&A activity, we've got valuations. all of these are giving us, a real opportunity to invest. And this is the main reason why, I can go back to the asset allocation. Our UK exposure is overweight. Compared to our benchmark, compared to our peers, we think the UK market offers some real value, hence we're overweight. So just summarising, this is where we're, prediction-wise, 2023 was a positive year, but during that year we had lots and lots of volatility. 2024, we think, is going to follow a similar pattern. We've got uncertainty of elections, we've got the geopolitical issues still in the background. That's going to create uncertainty for markets. The whole timing of interest rates, when are they going to be cut, is creating uncertainty. But we think as the year progresses and we start to see these interest rate cuts coming through, that will still deliver us positive returns over the year. We've had a huge shift in central bank policy. We've gone from zero rates, we've had a huge rise in rates, and now we know we've paused, we've peaked, rates are going to come down. Again, that's going to be supportive for both equity and bond markets. The headwinds, mentioned numerous times, we've got these risks, but they're known unknowns. We know they're there, we can try and react to them, but the key thing, all of this volatility, whether it's from economics, whether it's from geopolitics, we think that the best way to navigate through this is diversification. So whether it's within our UK exposure, we've got exposure to large cap, we've got exposure to mid cap, we've got exposure to small cap. We're covering those bases. We've got exposure to different asset classes. So we've just added to fixed interest. We've got thematic funds. We're trying to make sure that we're covering all those bases and navigating through that path that Simon showed on one of his slides, where we're trying to react to what all these risks are, but we know over the longer term, it's going to be economic fundamentals that are going to drive returns, not short-term events such as elections. And the active management part, we are actively managing the portfolios. We're looking at what's happening in the short term. We're making decisions on how to navigate that, but we're also looking at what our strategic positioning is. How are we going to benefit over the next 3 years, 5 years, 10 years? So that active management is really key. We have got a Q&A session. We've got a number of questions from clients. We're going to open it up to the floor. So please, if anybody's got any questions, please feel free to ask. There is a compliance slide that our compliance manager will tell me off for if I don't show it, but
Everyone read that, yeah?